Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be starting off a new series on the channel called Rate My Portfolio. I got this idea from Jake over at Dividend Growth Investing, and I'll leave his channel link in the description down below so you guys can check it out. Now, the way this series is going to work is based on how many portfolios I have to review. I'll try to make videos on it, and you guys can leave your portfolio down in the comments below, and I'll get to it as soon as possible. Ideally, please have US-based portfolios. Anything external to the US, I'll have a hard time knowing enough information about to give a good score. Now, speaking of score, at the end, just for fun, I think I'll give it a score from 1 to 10, and then we'll see how it goes from there. If you guys do like this kind of content or like this idea, definitely leave a like on the video and subscribe to the channel if you haven't already. I'll be posting weekly investing content. So for this first portfolio, my friend was nice enough to send me over his portfolio composition. As you can see here, we have the allocations of his different holdings, but we don't have the specific quantity of each holding. That's because he didn't want to give off too many details of his portfolio to me. However, this will definitely do because we can get a dividend yield from here and the allocation of each holding. This is his target allocation, so of course his individual holdings may be a little bit different right now, but this is definitely what he's aiming for. Now, as we can see here, his biggest holding is VTI. VTI is a total stock market index fund. It's kind of similar in structure to VOO, but it holds over 3,000 different companies. Now, this makes up 50% of his portfolio, so it's going to give him a very stable foundation to work with. Next, we have DGRO sitting at 25% and holds a similar purpose like people who hold SCHD. So DGRO is mostly a dividend investment fund. And as we can see here at 25% and a 2.39% yield, it's definitely a higher dividend yielder than his other positions. Next, he has VIG at 20% of his portfolio, and it's another ETF by Vanguard. It's the Vanguard Dividend Appreciation ETF. This fund's goal is to mainly hold on to companies that will appreciate their dividend over time. And last, he has two very small positions in individual companies, Walmart and Coca-Cola. I think these are very safe holdings, but we'll dive deeper into them in a little bit and I'll give my thoughts on them. So looking at the main dividend yield, we can see that Coca-Cola does come out on top sitting at 3.24%, and that's followed by DGRO sitting at 2.39%. After that, we have VIG, which is to be expected. It's the Vanguard Dividend Appreciation ETF. And then we have VTI coming before Walmart, surprisingly. He only holds a total of 5 holdings at the moment, most of which are ETFs, so he has a very safe portfolio in my opinion, and I don't think that he is much of a risk taker at this time. Now, to further push that narrative, we can see that his cash position, from what he's told me, is about 30% of his net worth, so he is definitely taking the safe approach to investing. Now, if you guys have been keeping up with the channel, you've seen my portfolio, I do have a different standard for how much cash I keep on the side. I think I keep about 10% of cash at the moment, and that's kind of where I like to have it. Now, if I'm able to, I definitely wouldn't mind growing my cash position closer to 20%, but that's just so that I can invest more in lump sums when I do find the good opportunities in the market. So I definitely don't want to hold more than 10% on a consistent basis. His average portfolio yield, or basically his yield on average for all his positions, is 1.79%, which I think is a very comfortable range. It's not too high where he's losing out on gains, but it's still pretty good, and he can see that dividend come in every single quarter. And I think this pie makes a very good visualization of how big his VTI position is. It's definitely leading the momentum of his portfolio, and these other positions are not as sizable, not even close. And Coca-Cola and Walmart are minuscule, so not really making a dent at all in his earnings. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. So starting it off with VTI, we can see it's the Vanguard Total Stock Market ETF. Now, as is fairly evident from the name itself, the goal of the portfolio is to track the entire stock market within the US. So taking a look over here, we can see that VTI is broken up into 11 different sectors. So the big ones that I'd like to note out are consumer discretionary, both consumer staples and energy. We have financials at 11%, healthcare at 12%, industrials at 13%, and technology at a whopping 32%, which is a very big weighting for this sector. So if you guys are familiar with the S&P 500, you can see that the composition here is very similar to that. We have Microsoft at number 1 at 6.12% of the portfolio, Apple coming in second at 4.93%, and Nvidia coming at third at 4.2%. So the holdings here are slightly less concentrated than the S&P 500, and that's because you have more stocks to distribute it over. So as you can see in this bottom right corner, it is composed of 3,676 different companies. Now, of course, the top 500 companies are going to be basically identical to what you'll see in the S&P 500, but past that, you'll have very small percentages in very small companies, and we'll take a look at that in 1 second. So if we skip down to page 27, we can see companies between 260 to 270, and you can see how small of a portfolio percentage that they play a part. Now imagine if we go any further than that. Basically, if we're going down towards the bottom of this list, let's go into the thousands, we can see that this doesn't even make a difference. So it's 0% of the portfolio, and it's because it's actually like 0.000 something of a percent, and that's because these companies are significantly smaller. This portfolio is weighted by market cap weighting, so the smaller the company's market cap is, the smaller the percentage of this portfolio it's going to have. That's why I personally buy the S&P 500. I don't really see a big reason in order to hold this over the 500 biggest companies in the US because it's very similar regardless. Now, ETFs usually come with an expense ratio, which is a fee you have to pay basically every year based on the amount you hold of this ETF. So VTIs is a very small 0.03%, which I believe might be the smallest we'll have today, aside from, of course, the individual holdings, which don't have an expense ratio. And so let's skip real quick to Vanguard's Dividend Appreciation ETF VIG. That way we can take a look first at the Vanguard ETFs and compare them to each other. The fund's main purpose is to find companies that increase their dividend each year. Now, of course, there's other rules that it takes into account based on market cap weighting and performance, but we're not going to get too much into that today. But as you can see right here, their expense ratio is actually 0.06%. So of course, it's still a very small amount, but it is double of VTI. Now, in terms of composition, this is broken down into 10 different sectors, with its biggest ones being consumer discretionary at 6.7%, consumer staples at 11.4%, financials at 20%, healthcare at 16%, industrials at 12%, and information technology at a whopping 22%. Now, although these sector weightings are different from VTI, they're actually not that much different as you may think. If we take a look at their top 10 biggest holdings, you will definitely see some familiar names, with Microsoft coming in at number 1 at about 4%, Apple at number 2 at about 3.68%, and Broadcom at number 3 in 3.35%. Now, just based on their top 3 holdings alone, I really like this ETF a lot. Microsoft, Apple, and Broadcom are all very solid companies, and of course, the rest of them over there are great as well. I personally hold United Health, Visa, MasterCard, and Home Depot in my own investment portfolio, so I definitely like these holdings a lot. Now, as you can see down here, VIG only has 340 holdings, so it's slightly more concentrated than other ETFs. If we jump down to some of their smaller holdings, we can see they still make up a substantial amount of the portfolio at 0.19%. I mean, it's definitely not that significant, but it still has a little bit of play in the portfolio's performance. Some of the notable ones here include Archer Daniels Midland Company. If you guys have been keeping up, they have been under a lot of controversy for some of their accounting scandals that have apparently been going on at the company, so that's definitely hurt their stock price a lot. We also have Discover Financial Services here, which has recently come under the news because it might have a merger with Capital One, which would be crazy. And we have Hershey's Company down here at 0.17% of the portfolio, so not too bad at all. And the last ETF that my friend holds in his portfolio is DGRO, which is the iShares Core Dividend Growth ETF. Now, technically speaking, this ETF has similar goals to both VIG and SCHD, but it has different ways in which it chooses its respective holdings. The expense ratio is the highest of the bunch, but it still sits pretty low at 0.08%. Definitely not something I would worry about too much. It's very, very affordable. Now, in terms of performance, we can see that it averaged out an 11.6% total return per year since inception, which is not bad at all. Now, like a lot of ETFs, this is benchmarked on another index. So the one it's benchmarking is the Morningstar US Dividend Growth Index, and that's what it's meant to track. Now, there are some familiar holdings here. Of course, all these holdings are within VTI. That is to be expected. And a lot of these holdings are also within VIG since they do pay growing dividends, but they do have different allocations here in this portfolio, or I should say in this ETF. The largest holding here is actually significantly lower than the other two ETFs, and it's a little bit more nicely distributed between the different stocks. We can see ExxonMobil comes in at number 1, followed by Chevron Corporation. So those are both two energy companies. And then we have Microsoft and Apple coming in at number 3 and 4. Similarly to VIG, JP Morgan manages to grab a top spot, and Broadcom does the same as well. Now, this ETF is a little bit bigger than VIG, sitting at 423 different holdings, so it gives you a little more diversification if it's something that you're looking for. But like I said, anything over 100 is already very diversified, which is why SCHD is not a bad ETF to buy. If we skip to page 5, there are some really solid companies here, but they make such a small weighting of the portfolio, so 0.7 is not that high of a percentage if you really think about it, but these are very solid companies with Caterpillar, Honeywell, Oracle, BlackRock, Starbucks, Lowe's, all very big and well-known brands. Now, in terms of total performance, year to date, DGRO is actually at number 1 with 3.5% total return. But if we look at the 1 year growth, we can see that VTI, or the total stock market index fund, is actually significantly outperformed both DGRO and VIG, even though they have bigger dividend yields. For the 3-year time frame, VIG gets on top at 20%, but they're all very close. And for the 5-year time frame, we can see that they're all similarly finishing up very close, with actually VTI taking the win. Now, over time, I do expect VTI to slightly outperform both DGRO and VIG, but I think these are all very solid holdings to have in your portfolio. I definitely don't think you need to hold all of them. Maybe choose an investment strategy that works for you and stick to it. One thing that I will say as an SCHD shareholder is that I actually like VIG and DGRO's holdings slightly more right now because I think SCHD is a little bit heavy in companies that are not that strong in the current market, like UPS. So taking a look at his fourth biggest holding, we have Walmart with a 1-year return of 18.51%, and year to date they're actually up 12.77%. Not sure what this big spike is about, but let's ignore it for now. I think it's probably a mistake on Seeking Alpha's side. For their 5-year time frame, they are sitting at 73.66% growth, which is great, and for their 10-year time frame, they're sitting at 126% price return. Now, if you factor in total return, that is the return including dividends, it would be significantly higher than this because you'd have to, of course, include that 1.4% dividend yield that they have had. I don't want to dive too deep into the financials in this video, but I can definitely do a focus video on Walmart if you guys want to see it in the future on the channel. Just let me know down below. But what I want to show you is how crazy their revenue is per year at $648 billion in 2023. That's basically the largest we've seen on this channel so far. Now, in terms of their dividend, we can take a look at their dividend scorecard. The yield is sitting at 1.4%, which is actually pretty comfortable in my opinion. I've said it before. Their pay ratio is under 40%, sitting at 34%, which is great. But their 5-year growth rate is terrible at 2.22%. I hate seeing that. Now, to add insult to injury, they actually did the largest dividend hike. If I remember correctly, it was about 9% this year, and even that still left it at an abysmal 2.22%, which is very bad, like I said before, and even Coca-Cola outpaces it in terms of dividend growth. But on the bright side, in terms of dividend growth, they have grown their dividend for the past 50 years, so I do think they'll continue to grow it if you are worried about that. But the funny thing is, believe it or not, Target actually has grown its dividend for more years consecutively than Walmart. Now, their valuation is always considered a little bit high. Walmart does trade at a premium, and it's just because of how defensive and how consistent this company performs. People like to hold in the portfolio for kind of like wealth management, not having to worry about too big of dips. Their growth is actually surprisingly not too bad for such a large company. Year over year, it's up 6%, but their forward-looking growth is a little bit lower at 4.73%, which is still not too bad. It's nothing like, it's no Visa, it's no MasterCard, but it's still pretty solid. Now, as you'd expect from a retailer, their margins are pretty small. Their gross profit margins sit at 24%, which is actually lower than the sector median, and it's about the same as their 5-year average, so they've been very consistent on that at least. And hopping into Coca-Cola, or the Coca-Cola company, we can see that for the past year, it's actually down 5.5%, which is not great, but it's on the recovery, up 2.1% since the start of this year. Now, if you guys do want to see a more in-depth analysis of Coca-Cola, definitely check out this video. I'll add it right here in some sort of info card so you guys can check it out. But I do an in-depth analysis of both Coca-Cola, Procter & Gamble, and Visa. Getting back to it, their 5-year growth is 26.94% and their 10-year growth is 45%. So as you can see, this is a very slow moving company. They have great revenues, but their growth rate is very slow for this revenue. And actually in 2020, it did dip down, unfortunately, but it has recovered since then. In terms of their dividend, we can see in their dividend scorecard that their yield is at 3.29%, which is a little bit higher than I like to see. Their pay ratio is 68.4%, which is also a little bit higher than I like to see. And their 5-year growth rate is at 3.5%, which is a little bit lower than I like to see. Regardless, they have grown their dividend for 61 years. This is a very solid and defensive company. And if you guys are looking for something safe to hold in your portfolio, this could definitely be a good option for you. Now, what I will say is I own one share of this company, which I am looking to sell at some point. I just haven't gotten around to it. And I think something to consider with it is that it's very slow growing. So most of you that have a long time horizon have no benefit of holding such a slow growing company. Their valuation does sit a little bit high for their company's performance at 22 price to earnings ratio, but it was sitting higher before, so I think you could find this as a good deal if you really wanted to hold this company regardless. Their 5-year average is sitting at 24.63, and that's an 11% discount to that average. In terms of growth, their year-over-year growth was fine at 6.39%, but looking forward, I don't see much growth coming up for them. I think this company is definitely on a slowdown, and they're just trying to continue selling their product, continue increasing those prices where they make a lot of their money in the meantime. Now, in terms of their gross profit margins, it's actually pretty high, sitting at right around 60%. That's because a lot of times other companies do the bottling for Coca-Cola, so they basically sell their, their formula, their drink, and the companies produce it and, of course, bottle it and distribute it for the company. Now, in general, for this portfolio, just to give you my thoughts, I think it's pretty solid overall. It's definitely a very safe portfolio. It errs on the side of caution. It's not too aggressive which is nice to see. You know, not everybody likes to take more risky plays. Now, what I will say is that if this was my portfolio, I'd probably trim both the Walmart and Coca-Cola positions. Compared to the other positions in the portfolio, they basically make up nothing. 3 and 2% is pretty negligible compared to the 50, 25, and 20% allocations for the rest of the holdings. And I think even if they skyrocketed, doubled, tripled, quadrupled in price, it just wouldn't even make a dent in the portfolio's performance. Also, both companies are just too slow growing and also have lower dividend growth rates than all these ETFs combined. So I would definitely just put the money into these instead. I think it would just be a better, kind of wiser decision in this regard. Now, when it comes to rating this portfolio, I'm going to rate it a 7.4 out of 10. I think it's a good portfolio regardless. It's very safe. It's what a lot of people should be holding as their portfolio. And I think there's nothing wrong with it kind of objectively. Just there could be improvements to it. Now, of course, that does bring us to the end of today's video. If you guys did enjoy this video, definitely let me know down below. And if you have any comments, suggestions on how to improve it in the future, also leave it down below. I want to improve constantly so I can get you guys better content. If you guys want to check out my latest video where I discuss whether or not it's a good time to buy Nike stock right now, check it out right here. And if you guys do want to watch my video where I discuss Bill Gates' top 5 holdings, click the link right here. Other than that, I want to thank you guys for watching, and I will see you next week.